understand when I am presenting, I'm sharing these slides with all of you. You know what is the intention behind how to use it to build a big Beija, build a big team, and get people licensed as fast as possible. All right. So, head coach, why don't you start off with us with some opening comments about what they're going to see in the next coming minutes here?
Hello, everybody. This is such an exciting time. I mean, today we have a big job to do. I mean, I have been prepared for this explosion for quite some time. The last few years, in my mind, how we're going to be able to double our number and triple our number in the next 12 months. And this is the time, you see, with the announcement, with all the preparation that we have to launch, and now we come to this moment, with I think this is a history in the making. 2023. Alicia gonna talk with you about have 100% control of your own future. Now, every one of you here, the SMD, the trainer, the leader, you can be able to solve one of the biggest challenge in your life in the business here is the lack of control, the uncertainty, the frustration of getting people licensed. Now with this one, when Alicia go through this one, the control back to you. You have 100% control of people licensed. In fact, what it took you maybe 5 years to build a handful of people, take you several years to get to 30 license in the base shop. I think it can take you in the next 6 months. You have 30 license. Some of you are gonna have. You got some of you by the end this year. You're gonna have over 100 license in the base. You have 100 people excited and happy, and they know that they can always recruit people, and they can know always that they can license, and they know those people will join. They be licensed, and they can make money. And this is just a beautiful time. And so instead of the most difficult factor when somebody join and take them forever to submit license, and then they go through the cram course and those training course that is so boring and so difficult to understand, and for a working man and woman, especially people who have challenge with a little bit of English as their second language. That anxiety now is over. With this material, you're going to hear what Alicia said, although we have short period of time and we're going to go with you, but we want you to, all of you here, learn this thing to teach, and then we're going to work together. Alicia is going to go a bit faster, but to me, every one of us can train this course. Because you know what? We all licensed. Billy Boy, we all pass license ourselves. You have life license, I have life license. So we know how to do it. During the time before I want to train my team, because I know I passed the test, I take the same books and material and I go through my team and I teach them to pass. Now with this material, oh my God, so easy. So because since we already did license, we understand what it is. We in the profession, we in the business for many years. So many of us right now, almost every one of us in the business and license like us, we can be able to share our this training with our team to help them. And some people may go fast. Sometimes we go a bit slower. Some people in a larger group, some people in a smaller group. But we put we make sure one thing that we have totally control in our hand is that we can be for sure now we can get anybody who in our team to pass the license. So it's just so exciting time. So I want you to hear from Alicia from a standpoint, and for people here who's a few of you who is not licensed yet, because of the time constraint here, it may take a little more than an hour and a half and 2 hours to go through this course, but let's say it takes you double the time, and you see this in a few times. I think this is going to be wonderful. But For the easiness of easy of this course, let Alicia go through. You have an idea, a concept, and you know what? The future is in our hand because we can train people in the office. We can train people on the Zoom. And if I travel long distance, let's say I go build Texas, Philip, I'm gonna get recruit some people, and I see this guy excited, and he have 4 or 5 recruit with him. I can sit down and tell those guys to study this one in a few hours, and I to explain all this thing, and the guys took the material and they read it a few more times. They pass the test within about 2 weeks. So there's so many things that we can do with this one. So Alicia, why don't you get started? And we have more exciting to share with the people by the end. Listen, don't you gotta fasten your seatbelt and don't go anywhere because it's gonna be awesome.
Okay, everybody ready? Just like the flight attendant. Can you take this buckle and insert into this buckle? Pull the strap, okay, and make sure it's tight. So please expect tonight, it's going to be about an hour and a half for me to go through this, and then another 20, 30 minutes for Coach to go through the bombshell announcement at the end, okay? So, yes, there is great news and then even greater news coming at the end. So you want to make sure that you don't go anywhere. I want to make sure you're all prepared for that, okay? So, again, like what Coach mentioned, this class, what is it expected to? I'm looking in Gold Tree. I'm looking in the on screen here right now. This is for people like Baby Rose, who's in Maui right now. You can teach this in people home in Kauai or, in the office in Maui right there. Jilcho, when you go to Seattle, when you go meet the team member, maybe you recruit people in a home BPM and you say, okay, hey, now I have 5 new members. Hey, let's get together tomorrow. And I sit down with you. Okay. So with interaction and everything, it should be, I estimate so far, it's at least about 2 hours. If you allow for some Q&A, allow for people to ask question, interruption in between. Today, because I have to kind of rush a little bit because we cannot be here for that long, and there's too many of you for interaction, so I'm going to go faster. I'm not going to do as many question and answer, but I probably do about an hour and a half. But I just want to go through it so that you can understand why I put these slides there. What are you supposed to explain? What do you focus on? Okay. And some of you that are studying might say, wait a minute, how come it's so much shorter actually? Even though it's 80 slides, it's a lot shorter than a lot of things that you study in the licensing class. Because remember, our goal is to get you to focus on the main things you just need to know to pass. Okay. So now let's go ahead and get started. So remember, we are going through the licensing preparation, which is today is going to be on life insurance. Okay. So this is just only one. This is only one set right now. I am going to wrap up health insurance and add that to this deck, and then a whole question and answer section. So that's why today you will see not as many questions as normal. So this is just life insurance only. It's also missing annuities, okay? But this is enough for you to at least study one section of the test first, okay? But this is just life insurance only. And then, of course, I need to go through my disclaimer, okay? The information should not be interpreted as any type of advice, and it's not a solicitation to offer or sell of any security or financial product. This workshop is purely for educational purposes only. We do not guarantee you will pass because of the presentation, okay? This does not replace any pre-licensing in your state or government, okay? This is only just an extra study guide. It's supplement, okay, for you to help you with the studying to make it easier. Thank you. Okay, so sorry, we are doing what we're doing. Okay. So how I'm teaching you the class, because actually if I went through the licensing exam, the information was a little bit all over the place. Okay. They have you study a little bit of this, a little bit of that, and then it goes back to life insurance. I mean, it's kind of confusing. So I think I got advice. Why don't we formulate the studying according to how you would go through the actual process as an agent? So as an agent, what's the first thing you're doing? You're trying to get licensed. You're learning where to take the license, what kind of licenses you have, what are the services you can offer. Then you've got to learn what products you can sell, right? So then you learn general insurance, general life insurance, and then you finally offer to the client, and then when they are ready to buy, you fill out an application, right? So what are the information you need to fill out the application? After you fill out the application, you go through underwriting, and then once it goes through, then you have to deliver the policy. That's the order of the it's not necessarily the order of the test, it's the order of how I'm teaching it to you so that it makes sense to you when terms of, and again, I'm just giving you concepts, and hopefully once you understand concepts, it doesn't matter what kind of questions are thrown at you, okay? So let's go ahead and get started. Let's start with getting licensed. Every day, right now, you turn on your phone, your TV, your website, and we are getting flooded with information. And a lot of people, even little kids in the mirror of their bathroom mirror, are giving you financial advice, okay? But they are unlicensed or they may not have industry experience. So what is the benefits of having the license? Is that you are awarded by a governmental licensing agency. You are given legal authority to work in this occupation, in this industry, and it means that you have met required minimum predetermined criteria. For example, like maybe a background check or passing a state administered exam, okay? So it is a privilege to be licensed, okay? And being a licensed agent, because it's a privilege, it comes with great reward, but also comes with great responsibility, okay? So with the life and health license, what you're going to be able to offer through WFG platform is all these different types of services: life insurance, fixed and index annuities, Medicare supplement, depending on the state, long-term care insurance, final expense, personal and commercial by referral, and home, auto, and pet insurance through referral program, okay? So imagine just one test, you have a lot of different things you can offer already, okay? And do we make money when we're licensed? Yes, we do, okay? So imagine you help somebody with a proper protection, okay? Assuming it's a $3,000 a year target premium, okay? So depending on what contract you have, this is the potential income you can make on one solution, okay? So let's just take the middle one, associate at 35%. One account could be $1,000 a month, or $1,000 for one account. So even if you only did one a month, what could an extra $1,000 do for you? Okay, could it help you pay off your debt faster? Could it help you save money faster? Maybe do something for your children, or maybe go on vacation. So how would you feel with an extra increase in your cash flow? Okay, so just to give you a little bit of incentive to be able to pass your tests. And now, one of the most common questions we get when somebody joins is that, do I have to be licensed in order to recruit people? No, you do not, okay? You can share about the opportunity as long as your AMA or agent agreement has been approved by WFG and you receive your COMA number. Once you receive your COMA number, it means you're good to go. You can start recruiting. The only time you need your license is if you want to talk about specific companies and products. Then you need a license, okay? Now, what kind of license and where do you get your license? You're going to get your license in your resident state. So resident means you hold a residence or primary place of business in a specific state. So let's just say, for example, if my house is in California, I should take the test, and I live in California most of the year, then I should take my test in California, and that becomes my resident license, okay? But, hey, if you want to share about life insurance products with someone that lives outside the state that you're licensed in, then you have to get a non-resident license first. But great news, you don't have to take the license again, okay? In fact, actually, my friend who's a lawyer, he took the bar in California, and every time he wants to take a license in another state, he wants to get his law degree approved in another state, he has to take the bar exam every single state, okay? But our license, life and health license, we are so lucky. We do not have to take the license again, or we don't have to take the test again. We just have to pay a fee and submit an application, okay? So with that, when you ask for a different state, that is called a non-resident license. It means that you are already licensed as a resident in your specific state, and then you're seeking licensure in another state. So I'm just giving you an example here. You might live in California and you want to get licensed in Texas, then that's called non-resident license in Texas, okay? So now let's do a little quiz. You have your life and health license for California, which is where you have your primary residence. Your friend John, who lives in Utah, is coming to San Francisco to visit the Golden Gate Bridge. Are you eligible to speak and sell California life and health products to John? Yes or no? Oh, Gold Street, good job. Yes, okay? You are all in compliance. Very good. Okay. Now, next question. The only license you have is your California life and health license, which is where your primary residence. You're currently at home, but you're on a video call with your friend John, who lives at his house and is currently at his house in Utah. Can you speak to John about any life and health products? Okay. The answer is no. Very good, Gold Street. Okay. So remember, in order to talk to somebody, and if they're in their own state and you're not, you have to have a license before you can talk to them in that state. So this gives you an example of that. All right. Now, types of agents. When you are licensed, you are commonly called an agent or a producer. Okay. So I don't know why. I know there's like in movies they call executive producer, or in music they call producer. Well, in our industry, when we get licensed, we're either called an agent or producer. So you might call some of the questions, I might say, this producer is blah, 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 or this agent is blah, blah, blah. So they're the same thing, agent or producer. Now, there's a type of agent. The first one is called a captive agent. Captive, or also known as career agents, work for one insurance company and sell only that company's insurance products. So let's say, for example, you really love a certain brand car. So if you want to buy that specific car brand, you're going to go to that dealership that only sells that car. So in this picture, you're seeing one brand, and even though they have different types of car, but they're all one color because it's all one brand, right? Okay. Now, there's something called a non-captive or independent agent. Those agents work for themselves and they sell insurance through multiple companies. Independent agents can represent as many companies that will appoint them. So imagine you don't know what car you want to buy. So you want to go to a dealership that has many different brands in the parking lot. Okay. So as you can see, this parking lot over here has many different color cars, many different types of cars, because they are an independent car dealership, or you're an independent agent. Okay. So that's the difference of captive versus non-captive. Okay. So when you are an agent, okay, you are considered very important. You are a superhero. You are a fiduciary. Okay. A fiduciary means a person in a position of trust. Okay. Why do we go see medical doctors about our health rather than go see the skinny person that is our coworker, right? Because we have a position of trust. They are licensed. They studied. They passed the exam to have that title. Okay. So fiduciary, you're a person of a position of trust, and you have a financial responsibility. No commingling of funds. You can't be part of you can't be part of whatever fraud that is. Okay. So remember, licensed agent, again, we're talking about a big privilege. So that's why you have to see how important and the responsibility. So sometimes you also call that you act as a fiduciary, which means that you always put the client first. You always put the client first. And how do you do that? It's called suitability and affordability. Okay. Suitability means you prioritize the coverage that best fits the client. And affordability means you find the right policy that the client can fund long-term. So let's say, for example, you find out a client, by the time that you calculate their mortgage and all their kids and all that stuff, they need about $2 million of life insurance. That is called suitability. But if you try to get them because you love permanent insurance so much, and the permanent insurance costs them $2,000 a month, and that's not affordable because maybe they only make $2,000 a month, then that might be the suitable coverage, but it's not affordable. Okay, so you got to prioritize the coverage. But on the other end, what if you find something that's affordable, but then it's not the right amount of life insurance? Let's say they can afford $50 a month, but then you only get them $100,000 a month, right? Or $100,000 life insurance. So then Sally, you're not giving them what is suitable, even though it is affordable. So you got to make sure you're meeting both criteria, suitable and affordable, and you are acting as a fiduciary. What's in the best interest of the client and having financial responsibility. So always do it right and do it with pride. So now that you understand all of your responsibility and the type of agent you are and where you're licensed, now let's talk about general insurance, okay? So what is insurance, okay? Insurance is a transfer of risk from one party to another through a legal contract. It provides a guarantee of compensation for a specified loss, damage, illness, or death. So shout out to me, ladies and gentlemen, what are the most common things that you have insurance for? Car, what else? Cell phone, what else? House, okay? Medical, health insurance, right? Maybe some people cover their diamond rings, their jewelry. Some people have pet insurance, right? Or if you have commercial real estate, you might have, property insurance. So have you ever purchased a warranty? It's very similar. It's all another words for insurance, okay? For insurance. So that is general insurance. And how is general insurance determined? Something called law of large numbers, okay? So insurance is based off of the sharing of risk amongst a large pool of people. The larger the number of people, the more predictable the losses are. Insurance companies use this data to calculate rates, right? So in my family, for example, my brother Nick, he really wanted a red sports car when he was 16. And we found out that the same exact car, Victor, just because it was red, the insurance was higher than if the same car was black. Why? Because they took all the large number of the people with red car, and people with red car tend to get more speeding ticket than the people with black car, okay? So that is an example. They literally told my family, hey, if your son changed the color of the car, your insurance can go down, okay? So law of large number, that's what is used to calculate insurance rates. All types of different, now it just depends what kind of insurance you buy, okay? That depends the data that they calculate. So of course, we're talking about life and health license. So most of our statistic we are using is about life and health, okay? Now, insurance companies do get rated. So nowadays we love reviews, we love rating, okay? And so the company, here are the names of some of the companies that rate life insurance companies on their financial strength, okay? So what you're gonna need to know for the test is the name of these 4 companies. So they might have a question that says, for example, all of these are rating companies except, right? And they might say AM Best, Fitch Ratings, Standard & Poor's, and McDonald's, okay? So the answer is going to be McDonald's. Does that make sense? Okay. So that's why you're going to need to know the name of the 4 companies. Okay. So, but basically what do these companies do? They evaluate the insurer's financial strength by looking at the company's reserves and the liquidity. Okay. So you just need to know the 4 names in the middle. That's the main thing you need to know. Okay. Now there's type of insurers. Okay. So they can be rated, and then there's different kinds of insurance company. One is called a mutual company, and one is called a stock company, okay? So a mutual company is owned by the policyholder, and a stock company is owned by the stockholder or the shareholder. So the policyholder, they look like me and you, okay? So that's why I try to put people that look like average, normal people, and the stockholders are people with a fancy suit, and they sit behind a desk, okay? So a mutual company, if there are insurance dividends, then they will give back to the policyholder through the cash value. But if there is extra money insurance dividend, then those people that we don't get it. It does not go to life insurance, right? The profit goes to the policyholder for a mutual company, whereas a stock company, the profit goes to the stockholder. So a mutual company can also be called a participating company. That makes sense, right? Because if the policyholder is part of the ownership, then they're participating. And the stock company is called non-participating. It does not mean one is better than the other, okay? Everything has pros and cons, right? So it's just you need to know the difference between mutual versus stock. They might ask you some question like, so and so, this is a mutual company. who does the profit go to, for example? So you might need to know that. So this is just general, you need to know. Now, they're not saying which one is better than the other, just definition. Now, speaking of definition, let's look into a few more terms. Hopefully this is common sense, but just in case, you need to know. What is an insurer? Okay, an insurer is a company who issues the insurance policy. Okay, insurer. Insurance policy is a written contract made by the company or the insurer. Okay, so just a note, one insurance company can offer different types of policies depending on the suitability of the client. But also, different insurers can offer same types of policy. So, for example, let's pretend the blue building. That company can offer term, whole life, universal, and many different kinds. But also, the second sentence means that the blue, the black, and the purple building can all offer term insurance, right? It's the same type of policy, but different companies. So, I mean, that not so much on the test. We just want you to understand. But the main thing here is insurer and insurance policy, the definition. Now, another definition is called a person. And most people think of a person as a human being, an individual, okay? And a lot of the times it is, but a person or an entity can also be a corporation, an organization or association, a trust, or a partnership, okay? So, for example, can an organization own a life insurance policy? Technically, yes. Can a trust own a life insurance policy? Technically, yes. So they're going to refer to these people or these things as a person or an entity, okay? So a person in this case doesn't always mean one person or one individual. So now let's go into types of life insurance. There are two main types of life insurance. To keep it simple down, if you broke it down, there's really just two, term and permanent, okay? So what is the main difference? The main difference between term and permanent is something called cash value, okay? So now you might hear things like, oh, cash value life insurance, etc. So term and permanent is the base, but if they call cash value, it just means a type of permanent, okay? And cash value is how the excess cash in the account is accrued. So now, let's talk about term, okay? There are types of term. The first one is called decreasing, okay? Decreasing. So what we're seeing here, I'm going to use all 20 years, just an example. We're showing a 20-year term, but this is a decreasing term, okay? What you can see is that you pay the same amount of premium for the entire 20 years, but in year one, your life insurance, if you pass away, they would pay out $200,000. But let's pretend you pass away in year 15. How much would it pay out? Would it pay out $200,000? No, it would probably pay out $50,000, for example. Okay, so that's why it's called decreasing term, but the premium is level, so it's called decreasing. Why would somebody buy this? Why would somebody be willing to pay every single month, even though the value is going down? Because it actually might be cheaper for the client, might be more suitable, okay? So oftentimes, this is also known as mortgage term, okay? So some people might buy this because they might say, hey, you know what? I just bought a house. I just want life insurance specifically in case I pass away. I want the kids to have the house, so I could buy it specifically for the mortgage, so that it's also known as decreasing term. Most popular type of term is called level term. Level term is that you guarantee a minimum amount of life insurance. It's the same amount of life insurance the entire contract, and you pay the same amount of premium the entire contract. So the death benefit is level and the premium is also level. Okay? That is level term. There is technically something called increasing term. Okay? Increasing term is basically, if you're willing to pay more every single year, then they can willing to give you a little bit more death benefit every single year for a certain period of time. So you can see the death benefit is increasing, the premium is increasing. Okay? So these are the main different types of term, decreasing, level, and increasing. But let's talk about level a little bit more because level is the most popular, and there's many ways that you can pay for level term. So term is the simplest type of insurance, and like renting an apartment, the insurance company will pay the death benefit should anything happen within the term. And then you can pay for it annually, and every year you can pay for it. Every year will go up. You can still pay for it. Okay. They call annual renewable term. Premium goes up every year. Or, just like renting an apartment, month to month is more expensive than if you sign a lease, right? So annual renewable term is like month to month. Okay. But if you sign a lease, you can sign a 5-year lease, a 10-year lease, or a 20-year lease. Okay. So what you're doing when you buy for the certain time period, like 5, 10, or 20 year, it means you're guaranteed to pay that amount for 5 years, 10 years, or 20 years. But after that term over, then you pay the higher amount for the next 20 years. Okay, so that's why you say, do you see every premium goes up every 5 years, premium goes every 10 years, premium goes every 20 years, or some people choose every 30 years even. So just depends on your preference. All right. So what is the advantages of term insurance? The benefits are that it's low cost and it's relatively inexpensive. So I always say it's better to have something than nothing. So term is great if that's what's affordable to you right now. And it covers liability for a specific amount of time, okay? But the disadvantage is that it's only insurable for that amount of time. So some people might realize later, like, oh, wish I had it longer, okay? Policy will lapse if the premium is missed. Premium is wasted if you don't die within the term. Becoming uninsurable forces you to renew at high rates, and the policy cannot be renewed beyond a maximum age. So you might be able to, if you buy it when you're young, you can keep renewing, even the price go up, but then there'll be a certain age where you cannot renew anymore because every company has a maximum. So that's the advantage and disadvantage of term insurance. So let's do a test question. Mr. X purchased a home with a 30-year mortgage. He is concerned that if he prematurely dies, the mortgage will not be paid. Which policy best suits him? A, annual renewable term. B, 30-year decreasing term. C, 30-year increasing term. Or D, 30-year level term. And I see some comments happening in the chat. Okay. So Marianne says B. Shweta said B. Okay. A lot of B's coming in. Let's see if you're all correct. Ding, ding, ding. Okay. What is the key hint here? Because the question had the word mortgage in there. Okay. So when you're taking the test, if the question has the word mortgage and the question relates to the client is specifically worried about the mortgage, then they're going to want you to pick decreasing term. Okay. So little hint there for you for when you take the test. All right. Now, let's talk about permanent insurance, okay? So if term insurance is like renting an apartment, permanent insurance is like owning a home, okay? And there's cash value associated with the account that could potentially generate interest to help pay for higher costs of insurance as you get older, okay? So as you can see, the little triangle grows with interest, and then that extra money can pay for the cost of insurance. So remember, everything else is permanent insurance, and then it's just different types depending on how the interest grows. So there's something called whole life, okay? There's called universal life. It's called index universal life, and there's a few more, but I will cover that when we get there. So now let's talk about whole life, okay? We're gonna talk about whole life first. So whole life is a policy you keep your whole life, okay? Typically up until 100. So part of your premium purchase is insurance, which can be sold back to a life insurance company, creating a cash value. So for example, okay, whole life, the main thing is that it's a fixed premium. So as you can see here, you pay a straight line, you pay the same amount for the rest of your life up until 100, and then they will give you interest. That interest helps pay for later years when the cost of insurance goes up, or you can use that to access cash value, that extra green box of money or cash value in there. Okay. So what are the advantages of whole life? It's a guaranteed interest rate. There you can do a pay schedule like 10 pay, 20 pay, or pay to 65. And it can be designed that way before the issue. And then permanent policy designed to last your entire life. Okay. But the disadvantages is that sometimes a guaranteed interest rate can be very conservative because they have to guarantee for the rest of the policy. Okay. Then the premium is fixed. So some people might be concerned, what if I lose my job or something like that? So then that's where whole life can have a disadvantage. And then death benefit is also fixed. So if you realize that you're putting in more money and you want it to be able to increase, that might not always be the best option. And then even though you can access the cash value, but when you access the cash value, then some of the guarantees are eliminated. You don't have those guarantees anymore. So, question. An accountant has income potential for 20 years and is looking for permanent insurance. Which policy would best suit them? A, 20-year decreasing term. B, 20-year inflation term. C, 20-year increasing term. Or D, 20-year pay life. Tricky. Okay, what's inflation term? Did Alicia talk about that? Okay. So that's a hint. Since I didn't cover it, it doesn't exist. So that's a fake answer. So let's take that out, right? So now we have A, C, and D left. So the main hint here, what is the main thing you want to look at when you're picking the answer? The accountant is looking for what type of insurance? Permanent. So the answer is D. 20-year pay life, right? And why did they trick you with this? Because they're saying that they want permanent insurance and that the income potential is about 20 years. So that's why he wants to pay for 20 years and have it be done with the payment. Okay? So 20-year pay life is the answer for that. All right. Now, when it comes to cash value policies, they have non-forfeiture options. Okay? It's a big word, non-forfeiture. What does that really mean? It means if you don't want to pay anymore. Okay? What are your options if you don't want to pay anymore? Non-forfeiture options. So there's 3 options. The first one is called surrender for cash. Surrender for cash. So what this means is that you see there is a cash or loan value dollar amount there. Okay. So the cash value that exceeds premiums might be taxable. Depends because you're canceling, you're surrendering. So whatever's over the premium will become taxable now. So let's say, question, a client opens a permanent policy and after 5 years, the client needs to surrender. They don't want to pay anymore. They want to take out whatever's cash is in there. They want to surrender it. How much is the client's surrender value? A, $2,500, B, $4,588, C, 0, or D, none of the above. Okay. Edna says B, Fresno says B, Erlinda says B, Irene says B, and Gold Street said B, okay? So the answer is B, 4588. How do we get that answer? You got to look at the table. You look at year 5, and the surrender value is 4588, okay? Very good, everybody. Okay. Now, the next type is called paid up permanent insurance. Paid up permanent insurance. You use the existing cash value to purchase smaller, fully paid up whole life policy. That's a hint there. Smaller, fully paid up whole life policy. So pretend your original death benefit is $100,000. If the client decides to use the paid up permanent insurance option at year 20, what is the new death benefit and how long does it last? A, 100,000 and 65 years old. B, 100,000 and 100 years old. C, 63,165 years old. Or D, 63,100 and 100 years old. Some people say C. Some people say D. Gloria said C. Michelle said C. Okay, Praveen said D. Beth said C. Norman Galanto said D. Oh, I forgot the Canadians on here. And even though Canadians, this is a US, but as you can see, a lot of these are similar in Canada. And also you're going to recruit in US, so you need to know this information anyways, okay? So, all right, let's find out what the answer is, everybody. D. Okay, so let's explain it to all the people that said C. Okay, so first of all, the death benefit. Okay, so most of you pick C and D, which most of you understood the concept of paid up permanent. So what it means is that the death benefit, you are opting to not pay anymore and then you guarantee a death benefit. Now, instead of 100,000, become 63,100. So very good on getting that answer right, because we showed you that is the option at year 20. Now, Why 100 years old? Because remember, it's still whole life, right? So remember, look at the description. Using existing cash value to purchase smaller, fully paid up whole life policy. Age 65 had nothing to do with it. It was just a little trick because you kept looking at that number right there. But whole life means until age 100. So paid up permanent insurance means you're getting a new face amount, smaller, but still until 100. Still until age 100. Okay? So that is the second option. Now, that is the third option called extended level term insurance. So remember, did I teach you about level term earlier? Yes, so that's just a little hint. What you're doing is you use existing cash value to purchase paid up level term. A maximum number of years and days must be identical face amounts. So the client is 50 years old and wants to use the extended level term insurance option at the end of year 10. At what age will his term expire? 56 and 118 days, 60 years old and 268 days, 68 and 72 days old, or 71 and 70 days old. Okay, Gloria said C. Fresno says C. Michael says C. A lot of C's coming in. Oh my God, I'm like so honored that you're all getting the right answer. C, 68 and 72 years old. So technically, I should have thrown in some death benefit in here, but why I didn't put it in the answer? Because it doesn't matter. Remember, it's the same death benefit. So had I put, if the death benefit is 50,000, it's still 50,000. All we're doing now is we're shortening the time. So you see, it's not 100 years old like the previous type, right? Now it's only lasting up to a certain amount of age because you use extended level term insurance. Okay. So in summary, again, the three ways is the first way is surrender for cash. So you can cash it out. You take the money out of the policy and you cancel the policy, but you get cash. The second way is you don't get cash. You use that cash value to either do paid up permanent insurance. So whatever that number is, but it lasts until the 100 age, or you either option, the paid up is less insurance, or the second, or the extended level term is the same death benefit, but not as much time and it's more. Okay, so that's the three different types. Okay, so now that we covered that, let's go through universal life. Okay, universal life is also known as adjustable. So that's a hint for you. Universal / adjustable. It's similar to whole life, that it's a permanent policy for your entire life. However, it has flexible premium with minimum and maximum and flexible death benefit. So instead of a straight line where you pay, sometimes if you have extra money, you can put in more. If you get a raise at your job, you can put in more. But maybe sometime you lost your job or you have financial hardship, you can pay less, okay? So that's why you can see the line of the premium is up and down, okay? That money still, as long as you pay the minimum and a little bit more, you're going to get interest on that. And again, same concept, that extra can either pay for the cost of insurance that goes up later, or you can access it for cash value, okay? That is adjustable or universal life. It means flexible. So what is the advantage? Flexible premium, flexible death benefit as needs change. Policy and payment can be designed during the life of the contract. Okay, permanent policy designed to last your entire life. And you have access to cash value. The disadvantage is that the guaranteed interest could be conservative and underfunded policies may require additional premiums later on in life. Okay, so if you don't meet certain minimums, you might be asked to pay more later. Okay, because it doesn't have the same guarantee like whole life. Okay, so it's more flexibility, but that also flexibility can mean you need to pay more later. So it depends on how you fund the policy. All right. So the next couple types of life insurance, they're all universal life. So they all have the U in there. Now we're just talking about how you get the interest. So what is the letter before the U? So now we talk about IUL, Index Universal Life. So Index Universal Life in some states can be called Equity Universal Life, and some states can be called Equity Index Universal Life, okay? So that's why we want you to know both names. It has the flexibility of Universal Life, but the cash value accrues crediting interest based off of a certain market index, as an example, S&P 500. So, as an example only, as a concept, flexible premium, so it can go, again, when you have a pay raise, you can put in more. If you have financial hardship, you can put in less. But how do you get that interest? Then there might be a floor, a minimum, and a maximum interest based off of a market, so like example, S&P 500, okay, using accrediting interest. So, all right, that's all you need to know for the test on one for IUL, okay? So what is the advantage? The advantage is accrediting interest has the ability to rise with index gain without market risk, okay? It has flexible premium, flexible death benefit, policy and payment can be designed during the life of the contract, print policy designed to last your entire life, and access to cash value. The disadvantage is same thing. Underfunded policies may require additional premium later in life. Okay, so now the last two is called variable life. So again, it doesn't have the word universal, okay, but the reason it's not in there, why it's not in the original bubble that we call our types of life insurance, I'm going to share with you. So variable, the main difference is cash value growth. Cash value is in a separate account or called a sub account, which are investments in stock, bonds, and other investment vehicles. Separate account is regulated as a mutual fund by the SEC, Securities Exchange Commission. Greater growth potential, so it's unlimited growth, but also it means greater risk, right? Greater growth means greater risk. So cash value and death benefit change every day based off of the performance, and there's no guarantee regarding the cash value. Okay, there's no guarantee regarding cash value. The death benefit, yes, but the cash value, no. Okay, so the other one is called variable universal life. So what does it mean? The cash value is up and down, but the premium is flexible. So they will want you to know what is variable and variable universal, and all they want you to know is you can't sell it. Because the license you need to sell it is life license and FINRA securities license, Series 6 or 7 and 63, depending on what kind of license you have. Okay? So they might ask you a question like, what is variable life? Can you sell it or not? Something like that. Okay? So just know with a life and health license only, can you sell it? No. You need also the FINRA securities license. Okay? But they do not want you to know the difference on the test. Okay. So that's why we don't go into it as a whole circle like in the earlier pictures. Question, out of these types of insurance, which combines a savings component with a flexible, that's what I emphasize, that's the hint to you, premium option? A, universal life. B, 20-year paid life. C, survivorship life. Or D, term life. Okay. I'm checking the chat. I'm so honored, chat. This is a smart group. Might not say that about the earlier time zone, but they're not on here. They don't know, right? Just kidding. All right. A, universal life, okay? You know, it might be that we have a live audience, you're shouting the answer, and they can hear it online, and then they're just copying what you say. Maybe, okay? So don't give yourself too much credit now. All right. So very good. Why did we pick A, universal life? Because the word flexible. Combine savings with flexible option. That's why we chose universal life. Okay. So now that you understand the different types of life insurance, now know that you can design the life insurance depending on who owns it and who is the insured. Okay. So for example, you can have a juvenile life on a whole life. You can have a juvenile life on a universal life. Okay. So what makes it a juvenile life is when the owner is the parent and the insured is the child. Okay. I think that makes sense. Common sense. Juvenile life. Okay. Now, the next one. This one is not as easy because there's something called joint life, and then there's something called survivorship, which I think we all are like, wait a minute, how do we know what is the difference? Because they both means two people together. So joint life means first to die. That's another way to think about it. Joint life means first to die. So as you can see, let's say a husband and wife, instead of getting separate policies, they want a joint policy. Okay? What it means is that when one passes away, only one of them needs to pass away, then the other spouse will get the check, but then the policy is done. Okay? So that is called joint life or first to die. Survivorship means second to die or last to die. So it means both of them have to pass away in order for the beneficiary to get the death benefit. Okay? So again, joint is first to die. So, why would somebody want this? Maybe, again, it could be affordability and they cannot afford two separate policies. But the downside is that when one of them passes away, now the other one doesn't have life insurance anymore. That is a downside. Survivorship is typically good for estate planning purposes because estate taxes kick in when both parents pass away. Okay? So that's why people have survivorship. But they don't ask you that detail that I just told you. They just want you to know, they will just ask you, oh, this person bought this type of policy. And then like A and B bought a joint life. A dies first. Who gets the check? Something like that. Okay? But if they say, oh, A and B bought survivorship and only A dies, does B get the check? And you have to say no. Okay? So that's an example. Okay. There's also business uses for life insurance. So the first type is called buy sell. Okay. So let's say, for example, me and Justin Mambahi become business partners, not in WFG. Let's say we are restaurant owners together and we both put in the same amount of money to open this restaurant. I put in $1 million and Justin Mambahi put in $1 million. We might want to buy a life insurance called buy sell, because if one of us pass away, we put so much money on the line. But what if our wives are not involved? Or what if we have kids and we don't want our kid fighting for the business? So we can make an agreement. So business partner can use life insurance for a business continuation in the event of one of the partner's death. Okay? We agree on a pre-arranged purchase price, which is a contractual agreement to sell. And it makes money available to the purchase interest of the deceased partner ownership right from beneficiaries. Okay, so basically the money will go to one of the partner depending who died. Okay, now key employee is for a business or a company to use. So who has to own it? The business has to own it. Okay, to offset the loss or hire replacement to the death of a key employee. Okay, so instead of now me and Justin are not partner, now I am the business owner. Okay, let's say I run a big restaurant and he is my general manager. He helped me run I put down the money to open the restaurant, but he helps me run it. And if he dies, it's going to take me a long time to train somebody, and it might make me actually lose some money because it's going to become not as many customers can be accommodated, right? So that is an example of key employee. Okay, so if Justin Mambahi passes away, does his family get anything? No. Okay. Whereas the buy sell, if Justin Mambahi passed away, what I'm doing is I'm paying out his family so that I can take ownership of the business. Okay, so the main thing you just need to learn for these two type of policy, you don't really need to know the details so much. The main thing you need to know to pass the test is who owns the policies. The business. Okay, the business is the owner and the payer, and insurable interest is met due to financial loss between the connected parties. Okay, that is the hint or the key things you need to know for this. All right. So now that you know all the different types of policies, you know how to design a policy, now you finally convince the client to buy one of these policies you just learned about, right? And then what's the next step you got to do? Fill out and submit an application. Okay, so how do you fill out application? Number one is called owner or applicant. The owner of the policy is the person who has control of the policy during the insured lifetime. So If the owner is different from the insured, they are the ones that have all the control. They have power to access the cash value. They have the power to surrender the policy and the power to change the beneficiary. Doesn't matter who the insured is. The insured is just the person whose life is being insured. We're just using your age, your health, your life. Okay? Beneficiary, the person that's entitled to receive the death benefit when the insured passes. Okay, so who has all the control? The owner. Okay? So, if the owner and the insured are the same person, then this is considered a two-party contract. Why? You can see there's only two people involved. Owner and insured the same. So it's just a contract of that person between the insurer or the company. Okay? But if the owner is different than the assured, this has now become a third-party contract. Somebody else is buying a policy on somebody else. Okay? So it now becomes third-party contract. All right? So how do you buy insurance? Can you just say somebody walks down the street and it looks like an old person? He said, hey, you look like you're going to die soon. I'm going to get my money back if I'm going to buy you a life insurance policy. Can you buy a life insurance on anybody? No, okay? Giving you examples so that you can understand. In order to purchase insurance on a person, the owner must possess insurable interest in that person. Insurable interest is typically based on financial relationship and must exist at the time of application or policy issue. Okay? Not like, oh, I plan to take care of this person or I plan to. No, it has to be right now when you apply. So for example, does a son and a mom, let's say an older mom and you are taking care of your mom, do you have insurable interest in that mom? Yes, okay? Or two business partners, right? We are in business together, so we have financial interest in each other, right? But an upline, downline, if you're not family, you cannot say, oh, Zong, you are my downline, so now we have insurable interest, I want to own a policy on you. That does not necessarily make sense to the insurance company or to the insurer, okay? So, just some examples. Okay, so again, this is where I would open up and say, anybody want to give me examples or have questions on what insurable interest means? I don't have time for that today, but I would do that in a smaller setting so that I make sure they know. They would say, oh, well, what if my brother lives with me or something like that? Or what if I have my nephew that I'm taking care of, in my house? Then those are great questions to be able to answer. Okay, so anyways, but I think this is pretty clear, right? Okay, so question. What is the main purpose of insurable interest? A, to allow someone to buy life insurance on anybody they choose. B, establish a new form of gambling. These are real questions, by the way, okay? I did not make these up. I have people that are instructors that help me put these questions that are on, okay. Protect and preserve life against foul play. Or D, experience a profit if someone were to die. Okay? A, B, C, or D? Why are you not as confident in this answer? That worries me. Okay, that worries me. What is the answer, everybody? Oh God, I think I saw someone put the answer D. I'm a little bit worried, okay? It's C, protect and preserve life against foul play, okay? Okay, hopefully you all understand what foul play means. All right. All right. What if a life insurance company goes bankrupt? One of the most common questions we get. Well, in a very rare case, there are state guarantee associations that act as a safety net to protect policyholders if the insurance company that issued the annuity or life insurance policy has insufficient assets and cannot meet financial obligations. So it's a long and fancy way to say, look, if the insurance company goes bankrupt, don't worry. There is a state guarantee association. They make sure they have the minimums to be able to pay out. Okay? So state guarantee association is a safety net. All right. So as a licensed agent, we aid in limiting exposure to money laundering, tax evasion, and other financial crimes. Some red flags that insurance companies will look for are rapid movements of funds. Maybe a client's rushing you. Hey, we need to open this right now, or I need to make sure it's open and approved by the 10th or something like that. That might be a red flag. Lack of clarity regarding somebody's identity. Okay, if they don't want to tell you, what they do. They don't want to tell you what their job is. Oh, don't worry about it. I have money. That's a red flag. Lack of clarity regarding source of funds. Okay, hey, I have all this money in the bank, but where'd it come from? Was it inheritance? Is it from your job? Don't worry about it. I have money. Okay, that's not good. Okay, inflated financials. So they say they make $3 million, but they live in not a good part of town, or in a very, you can tell, it doesn't really make sense. Or unrelated third party, all of a sudden somebody random wants to own a policy or be the life insured, the insured, or cash intensive business sometimes are also red flags. Okay, so refusal to disclose identity or source of funds is one of the biggest red flags of a financial crime. And fraud represents intentional deception. So that is one of the questions they ask you, what is fraud? And fraud is intentional deception. As an example, writing business with no intention to place, and so you write the business or write the sale just in order to receive commission, advance, or a specific promotion. Okay, so that is the example of fraud and is illegal. Okay, so don't do it. Okay, now you have filled out the application, okay, and you have submitted it. Now it's time to go through underwriting. Okay, submitting the application is just the first step. After that, you go through underwriting, and then you still got to make a decision and deliver the policy. So the purpose of underwriting is to determine whether to accept the risks of the applicant and insured applying for insurance coverage. So again, getting approved for life insurance is a privilege. Just because even if you have all the money in the world, you cannot just buy all the life insurance you want. You have to qualify for it, okay? So when you apply, one of the forms you're going to sign is called a HIPAA form. And that HIPAA form basically releases your personal information, your health information, to the underwriters. What type of information, you ask? Well, the application itself, which has your personal answers on there that when the agent did the question and answer, the agent's report, and the personal interview. Then they might even reach out to your doctor. So that is called attending physician statement, or APS. They might ask for a paramed, so which means that, they want to look into something more, so they might ask you for a blood or a urine sample. Okay, Medical Insurance Bureau, or MIB, they might want to look into your health history. When was the last time you saw the doctor, or do you have any family history? Okay, and then even maybe your driving record as well. Okay, so those are all the different factors. Now, you could be approved for life insurance, but denied for certain riders. The reason is because underwriters look at two different statistics. One is called mortality, and the second one is called morbidity. Okay, so mortality is what is the likeliness of you dying. Okay, so that's actually where we use our life insurance license. And when we take the test, we actually typically take three license and one test. The second one is called morbidity, is a likeliness of getting injured or illness. That is called accident and health. Okay, so let's say, for example, arthritis. Arthritis is not necessarily something you're going to die from, but very likely you're going to have disability from, right? So you would be ranked high on the morbidity table, but you would not rank that risky on the mortality table. Okay, so that is the difference of mortality versus morbidity, and that's what our licenses are able to offer when we have life, accident, and health. So how does your mortality and morbidity tables translate to your rate or risk classes? Okay, so life insurance groups people with similar mortality risks into categories called rate classes. Some examples of the names are called preferred plus, preferred, standard, table rated. Some people call it non-tobacco. Some people call it preferred elite. Okay, it doesn't really matter, but in general, they just have a ranking. So how does it change your policy? So you can see here example of different premiums based off of your rate class. So for example, if you're a non-smoker and you are preferred, it means maybe you pay 368. But if you are table rated, like they could call table C, then it becomes 688 for the same amount of life insurance. Okay. And smoker, non-smoker, you can see the difference. So set expectations with your client before the application. You and your client should understand that the rate class quota is not set in stone and will ultimately be determined by the underwriter. Okay. So, question. Who are the potential parties that must sign an application before underwriting can begin? A, applicant, insured, beneficiary. B, applicant, insured, and agent. C, applicant, beneficiary, and agent. Or D, applicant and insured. Okay, I got some B's, I got some D's. Okay, we're getting a lot of B and D in the chat as well. I got an A, okay. Okay. The answer is B, okay? So let's go through this question together so that you understand. For the people that got it wrong, I want you to pass your test. So, number one, the beneficiary does not need to sign, okay? Because they are the one that get to inherit the money. So they typically don't need to agree to inherit their money, right? They usually want the money. So usually beneficiary does not need to sign. You can take that out of the answers. So it's not going to be A, it's not going to be C. Now, both of them have applicant insured. So why do we need the agent? Well, the agent is the one submitting the application. You are the one writing down the information, and you are honoring that you interviewed the client, but also that you did your fiduciary responsibility to explain to the client as well. So you are also responsible for the life insurance application. So the main people responsible for life insurance application is the person who's applying, the insured, if they are different people, and the agent. Okay, so that's why the answer is B. All right. Okay, now let's talk about riders. I actually think I'm gonna move this to the general insurance section. I forgot why I put it in the underwriting section. But anyways, I think it might have to do with the mortality and morbidity table, but whatever. So if you see it early in this presentation, don't freak out. Same slides. Okay. When you buy a car, you can customize your car. You can customize the paint color, the speakers, the wheels, the rims, right? Okay, and then depending on what you pick, you might have to pay a difference, okay? Same thing, so just like buying a car, riders are optional features that you can add to a policy to customize your life insurance for an additional cost, okay? So, let me go through some riders. Again, riders in general, at least in California, it's only like 4 questions, so there's not so much you have to freak out about, but I'm just giving you some general ones in case, okay? So the first type is called other insured rider. You want to be able to add, what it is you're adding another person in the policy. If it's a spouse, you can add them up until they're 65, or if they're a child, you're adding them because you want them, and you want to be able to convert their policy between 18 to 21, okay? So that is other insured rider. Next is guaranteed insurability rider. So let's say, for example, right now, you only want to buy 100,000, but you want to have the option to buy more. So you can add something called guaranteed insurability rider. What it allows you to do is to buy additional amounts of life insurance at future date without needing to take another exam or prove your insurability, okay? But it's limited to a certain age. They're not going to let you do it like you cannot get it all the way till 80 years old, for example. It might be limited up to age 30, 40, whatever. And then, but the new insurance, you will have to pay the new price on that new age, okay? Next one is return of premium rider. So your hand is out because at the end of the contract, you want your money back. So that's called return of premium. And then payer rider this is only for juvenile policies, but premium is waived if the payer dies or become disabled, because remember, it's on a juvenile. So usually the owner is a parent or somebody older. So if the payer is insured or dies or gets disability, then the premium is waived until 21 years old. The juvenile is 21. So at that time, either the juvenile could take over or they can just cancel the policy. Okay, it's up to them. All right. The most popular ones they will ask you questions on is called waiver of premium. Waiver of premium is that premiums are waived if the owner becomes disabled for more than 6 months. Okay? The dividends will still be paid, the cash value can still grow, but it will expire at age 65. Okay? So what is this for? So let's say, for example, you hurt your back, like the guy in the picture, and you have disabled. So for the first 6 months, you still pay premium every month, even though you're disabled. Why? Because this rider is for more than 6 months. So in your 7th month, if you're still disabled, then in the 7th month, your premiums for the first 6 months will be refunded, and then the future premiums will now become waived. Okay? So that's waiver of premium. Then they have waiver of premium with disability income. It's the same exact thing as above, except you include a monthly disability income check that they send to your house. How much depends on the policy amount, okay? But it usually pays for 2 to 5 years, okay? So that is waiver of premium with disability. So let's ask a question. W has a waiver of premium with his universal life. He suffered a disability due to illness for 18 months. How many months will his premium be waived? A, 12 months because of the waiting period. B, nothing because disability is for accidents only, not illness. C, 18 months. Or D, 12 months because that is the maximum months. Okay. Let's see, a lot of the chat. Okay, I got an A in the chat, but I got 2 A's now. Okay. But I'm getting a lot of C's. I did get another A. Interesting. So I'm getting like 97% C's or 98% C's. I got 2% A's. The answer is C. Okay. Why? Because remember, because it's over 6 months, the premiums will be paid back, right? So they still got premium waived for a total of 18 months. So waiting period doesn't have anything to do with how many months the premium will be waived, right? Okay. You just have to qualify by being disabled for more than 6 months. Okay. All right. Last type of rider. Accidental death and dismemberment, also known as AD&D. Okay. And the next one, accelerated death benefit rider, known as ADB. So I wanted to put these 2 next to each other so that you can see, because the letters wise, it sounds similar. AD&D, ADB. What is the difference? AD&D, accidental death and or dismemberment, provides additional death benefit if the cause of death is accidental. Multiplier coverage is 2 or 3 times, and the death must occur within 90 days after the accident. So for example, I buy a life insurance of $100,000, but I add an AD&D rider. Tomorrow, I get hit by a bus, I pass away. So it was an accident, right? So instead of getting paid out $100,000, I get paid out $200,000. Okay. Second one, ADB, is a terminal illness rider. When my doctor tells me because of maybe cancer, I only have less than 6 months to live. Well, in this case, less than 24 months. So it depends on the policy, depends on the insurance company. Let's say they say, oh, you're at stage 5 and you only have 3 months left. Then I qualify for ADB. Okay. I can receive a percentage of my death benefit in advance of my death. Okay. So question. John has type 2 diabetes. He had his right leg amputated, and then 7 months later, he died from the same illness. He has $100,000 life insurance plus AD&D rider with double indemnity and $20K principal sum and $10K capital sum death benefit or capital sum benefit. How much does his beneficiary receive? A, 0, B, 210, C, 110, or D, 100? Oh, it's so quiet in Gold Street now. Oh, you were so confident before, Gold Street. Okay. We got 99% licensed agents in the room. Uh-huh. Okay. Okay, everybody do a drum roll on your legs. Ready? The answer is D, 100,000. Why? Because yes, he was dismembered. Dismember means you have something amputated, but it was not because of accident, right? He got his leg amputated because of type 2 diabetes. It's not an accident, okay? So that's why they just throw out all the other words and numbers to you, capital sum, principal sum, to throw you off, but it's actually just a regular life insurance. So it's 100,000 because he died of health, not because of accident. I tricked some of you, right? Okay. So the last rider we are going to talk about is long-term care rider. Okay, it accelerates the death benefit for long-term care needs. And there's two ways to qualify. The first one is that you must be unable to perform 2 activities of daily living for at least 90 days. So let's just say you get into a really bad accident and you're not able to go to the bathroom by yourself or be able to feed yourself for more than 90 days. So then you qualify for long-term care, okay? Or the other way is that determine that a person suffers from cognitive impairment like Alzheimer's, stroke, or dementia. Okay, so those are 2 different ways. Again, that's all you need to know. Okay, the other things that agents know about like 2% and how much, that's a sales thing, not a license thing. So for the license, they only need to know how do you qualify for long-term care. Either 2 out of the 6 daily activity daily living, or Alzheimer's, stroke, or dementia. Okay, that's how you qualify. Okay, conditional coverage. What if you pass away while your application is still in underwriting? Coverage is effective on the condition that the applicant is proven to be insurable on the date of the application or the medical exam. So generally you can be conditional coverage or temporary coverage once these are submitted. It has to have 3 things: the application, the initial premium, and the medical exam. Okay? So example, a healthy applicant dies suddenly while still in underwriting. If the client was conditionally covered, the insurance company would continue underwriting the application. If they would have approved the application, they would pay the claim to the beneficiary. Check with every company for their individual rules, but this is in general the term called conditional coverage. That's why every time we usually have clients apply, we recommend premium and medical with the application. Now, I'm going to give you another term called free look period, and then I'm going to test you. So after the policy is issued, it's important for the agent to deliver the policy to the client and review all the information. Once the policy is delivered, that is the start of the free look period begins. Free look is a specific window that a client can change their mind for any reason and cancel the policy without penalty and receive a refund of the initial premium. A lot of us, when we buy on Amazon, we want to look for the product that has refundable, right? Or why do we love Costco and Nordstrom? Because it's refundable, right? So free look period means refund, okay? So it can range between 10 days to 30 days. It depends on the state. So this one, depending where you're studying, Californian, go look up in your licensing, California free look for life and health insurance. Illinois, go look up individually because everybody is different. But normally 30 days will be the typical free look period for at least senior citizens, 65 and above. Okay? So let's do some test quizzes. January 11th, the insurance company receives application and initial premium. January 16th, insurance company receives medical exam. And now applicant meets rules for conditional coverage. Why? Because I got all 3 now, right? February 22, insurance company approves application and issues a policy. February 26, agent delivers the contract to the client. On what day does a client qualify for conditional coverage? January 11th, January 16th, or February 22? A, B, or C? Okay. Even the chat is giving me A, B, and C, all 3 answer, okay? Okay. This is why we have 4 slides on this, to make sure you know. The answer is B, January 16th. Remember, conditional coverage means application, premium, and medical exam. 3 items. Second question, what days does a free look begin? January 16th, February 22, or February 26th? Okay. Good. A lot of people getting this one right. I had some, okay. All right. Some people getting wrong, but it's okay. All right. It's only the first slide. You better get it all right by the 4th slide. Okay. C, February 26th. It does not matter when the policy is approved. Free look starts when the policy is received by the client. Okay. So approval does not mean free look. Client has to be delivered the policy. That's when free look happens. If the client accidentally dies on February 1st, pay attention to the dates, would the insurance company pay the claim? Yes or no? Go straight. Ay, ay, oh. The answer is yes. Okay. Remember, why? Number 1, they receive all 3 things. And then secondly, they see if the client passed away, based off of what you see here, the insurance company eventually approved the application. So even if you conditionally die, or if you accidentally die before February 22nd, what they would do is continue the underwriting. If they saw that they would have approved you, they would pay the claim to your family. Okay. All right, let's test you again. This is why we're doing it many times. January 11th, insurance company receives application, medical exam, and premium. January 16th, client passes away from a car accident. February 22, insurance company declines the application because the client's medical exam results and they returned the initial premium. So they found something. Maybe they found like too much sugar in the blood or something like that. Okay. So first question, on what day does a client qualify for conditional coverage? A, B, or C? 11th, 16th, or 22nd? Okay, a lot of A's coming in. Good, we're finally getting the answer right. Good job, okay. That's why we're doing this, repetition. Okay, when client accidentally dies on January 16th, does the insurance company continue to do underwriting? Very good, yes, okay. Now, last question. When client accidentally dies on January 16th, would the insurance company pay the claim? No, because eventually they realized they would not have approved him. They would not have approved him. So even though he qualifies for conditional coverage, it doesn't mean, just because you qualify for conditional coverage does not guarantee that you're going to get insured. You're going to get accepted. Okay. So those are 2 different things. So last slide. Okay. Oh no, this is not, 2 more slides. Okay. January 11th, insurance company receives application and initial premium. Then January 16th, insurance company approves and issues the policy. Okay, so let's see if you can get my hint here. February 22, agent delivers a policy to the client. And February 26, client passes away. Does the client qualify for conditional coverage? Yes or no? I heard the non-licensed agent answer correctly. Very good. No. Oh, see, some of you in the chat said yes. Okay, they do not qualify conditional because they need 3 things. What's missing? Medical is missing, okay? So remember, application, premium, and medical. Application, premium, medical, like 3. It's okay, you gotta take the test. You gotta take my class more than once, okay, before you pass your test. All right. If the client accidentally passed on January 13th instead of 26th, would the insurance company pay the claim? Okay, no, yeah, now you're getting it because it did not qualify for conditional coverage. Last question. When the client dies on February 26th, will the insurance company pay the claim? Yes, they will. Because it's approved and delivered. Okay, so conditional coverage is separate from actually getting approved and delivered. All we're talking about, conditional coverage only applies for if I accidentally die during underwriting. But once it's approved and delivered, that means the insurance company already accepted it. Okay, so that's why, yes, they would pay the claim on that one. Okay, last question. Trial app. Clients can submit an application without paying initial premium and still go through underwriting. Okay, since no initial premium submitted, the applicant does not qualify for conditional coverage. Full coverage is effective when the policy has been issued and the premium is collected. Okay, January 11th. Insurance company receives application without premium, but underwriting begins. January 16th, applicant completes medical exam. February 22, insurance company approves and issues the policy. February 26, client submits the initial premium and agent delivers the policy. What day is the policy effective? A, B, or C? Okay. All right. Most of you getting it right, so good job. Finally. Oh, thank God. Okay. Finally, February 26th. Okay. If the client actually passed on February 20 or on February 23rd, if the client accidentally passed on February 23rd, would the insurance company pay the claim? Yes or no? Oh, finally, Gold Street, thank God. Okay. No, you're finally getting it, right? Because they didn't complete all the requirements for conditional coverage. Okay. All right, we're finally done with that. Because I think you got it by now. Okay. But so when you're going to have all these test questions, they're not going to put it in a pretty calendar like me. It's just going to be a really long paragraph that says, insurance company received the application on January 11th. The client passed away this. The free look period started this. Does the whatever. So it's not, but maybe you got to use my visual. You got to use your piece of paper, whatever you got to do to separate it so that you know how to answer the question. Okay. So, all right. There is one more thing after you deliver the policy. After you deliver the policy, there is still one more time period called incontestability clause. Incontestable clause is a set period, usually 2 years, to detect fraud, errors, or misstatements at the time of the application. So even though it's delivered, but the insurance company still has 2 years to still make sure you told the truth. Okay? So some people are like, what? They already approved it. It's in writing. Why? Okay, well, there's actually 2 reasons for this. For the insurance agents, or for the insurance company, the insurer, how this protects them. Well, if the client passes away within the first 2 years of the issue date, the insurance company has the right to review and investigate whether the client gave incomplete information. If the insurance company can prove that false or incomplete information was misrepresented on the application, then they don't have to pay the claim. So they found out that you lied or you didn't tell the whole truth or that you left out information, so that's why you got to be really honest, because if they fight you back on it, then they do have the right not to pay the claim. Okay? So, well, you're like, well, why? That's not fair. Well, it is fair because on your end, you get to benefit too. If a client health changes, right? Let's say you got to prove everything and then you find out, a year later you have cancer, right? And you don't pass away until after the 3rd year. But even sometimes you can prove that in the moment you told the whole truth and you pass away 6 months later. As long as you were totally truthful and honest, they will still pay out. Okay? So, but in this example, if your client health changes and passes away in the 3rd year, it doesn't matter what, the insurance company has to pay the claim. Okay? So, there is one more clause called the suicide clause. Okay? It's not covered in the first 2 years. If that person does commit suicide within the first few years, the insurance company will refund the premiums to the beneficiary. Okay? But suicide is covered after 2 years. Okay? So just 2 little clauses you need to know for the test. There might be more in the medical or in the licensing exam. One conversation, please. Okay? So there might be more clauses in your testing, but these are the main 2 that they're going to ask you about: incontestability and suicide. Okay? So now you delivered the policy, the client's been paying for it, but then something happened and they stopped paying. Okay? So what happens? If they stop paying, the first thing that happens is something called a grace period. A grace period is 31 days after the premium due date. Even if the client passed away during grace period, it's very nice. They will protect the insured and the policy owner. So that is called grace period. However, after grace period, no more. The policy will lapse. And if you want, then the only choice you have, if you want the same policy to go back, you have to do reinstatement. So after 31 days, it's called reinstatement. If a cash value policy lapse, you can reinstate within 3 to 5 years by providing proof of insurability. So that's the bad part, right? Don't let your policy lapse and go into reinstatement. Then you might have to prove insurability again. Okay, and then you have to not only pay back the premiums, but also pay back interest required. Okay, so check individual state or insurance company for their individual requirements. Okay, but that is the difference of grace period and reinstatement. Grace period is for the first 31 days after the premiums due, and reinstatement is for after that, up to 3 to 5 years. Okay, we're almost getting to the last couple concepts here. So if you pass away, it goes to beneficiaries, right? Beneficiaries don't have to be only people. They can be trusts, charities, businesses, associations, etc. Okay? Now, so you are in the insured on top. The first person in line is called primary. Those are the first people. If you pass away, you want them to have the money, is your primary beneficiary. Then, if for some reason those people pass away before you, that is called contingent, second in line. And if for some reason both of those people pass away, then there is a third in line, which is tertiary. Okay? So all you need to know is primary, contingent, tertiary, first, second, third in line. Now, they might ask you a question on something called common disaster. So common disaster is that they say, what if the they will say, you know, Bob, Sally, Harry, and Joe all died at the same time. Okay, so in this example, look at the first people, the insured, and then the primary. They all died together. Okay, then the insurer will use common disaster clause. They will assume the primary beneficiary died first so that the death benefit can be paid to the contingent. So let's just look at the picture for me. If for some reason the first 4 people all pass away in a hurricane, okay? So if they said that the insured died first, that means the check's supposed to go to who? The primary. But the primary died at the same time. So if they pretended that the insured paid first, then now the check goes to the primary estate. And maybe somebody has to fight through probate because they die already. They don't know who to pay to. Does that make sense? So that's why if all 4 people die at the same time, they will pretend that the primary people died first so that the money can actually go to living people, which is the contingent or second in line. Okay, I think that's actually pretty cool from the insurance company. Okay, so that is called common disaster clause. They will usually ask you, common disaster clause, who died first, insured or primary? And your answer is primary died first. Okay, so there are also that is the primary, contingent, tertiary is what line they get it, Revocable or irrevocable is the type of beneficiary. So revocable is unlocked, which means can be changed, or unlocked means is easy to open, right? So revocable beneficiary means the client can add or remove the beneficiary without the beneficiary consent. Okay? So today I want to put my husband, tomorrow I want to put Avery, my son. I don't need to ask Andrew permission. Okay? I can do it because it is revocable beneficiary. But if I make Andrew irrevocable beneficiary, I have to get his consent before making any changes. Okay, revocable versus irrevocable. Why would you want to do this? It's mostly for estate planning purpose. Okay, so question. B would like to change a revocable beneficiary. Which is true? A, B needs to notify the beneficiary the intent of change. B needs to call his agent and trust that the agent will take care of it. C, B needs to get signature from the new beneficiary and submit it to the insurance company. Or D, B needs to fill out a change of beneficiary form and just submit it to the insurance company. Oh, finally, Gold Street game. Thank you. Okay, the answer is D. Good job. So remember, revocable. The key thing is revocable, which is the unlocked, right? Okay. So last slide here. After everything, finally you pass away, it goes to beneficiary. How does it pay out? Death benefit settlement option. Okay. Most people choose lump sum. It's just pay out right away. But technically, there are other options. Fixed period, fixed amount, interest only, life income. Honestly, the life insurance or the test is not going to ask you detail of all these. They just wanted you to know that there's multiple options. A question might be, what are the options of death benefit settlement? So they were not going to ask you, how does fixed period work? They just want you to know, or they might say, which one is not an option? Does that make sense? So you just need to know what are the options. You don't need to know what is interest only, what is life income. So that's why I don't have any information on it for you. It's technically in the notes if you really wanted to read it, presenter, but I honestly just would rather you focus on what you need to do to pass. Because 99% of people choose lump sum. So, okay. That's it. So, what is the next step? You'll pass. No, it's not. I don't guarantee you pass, okay? There's just a study guide. So take the next step with your trainer, quickly finish your pre-licensing, get licensed, get appointed, help families by educating and providing proper solutions. So how do you feel? Do you feel like you can teach this to new people? Do you feel like we can get people licensed faster? Okay. So let's get people licensed faster and get them to help more families faster. All right. So again, this is just part one. I still have to finish annuities and health insurance and the question bank. Okay, that is going to come very soon. But I think that you can all agree this is a very good amount to get people started on the first half of their test. Okay, it's something is better than nothing, right? So I hope you all really like the licensing prep. And now, for the moment you've all been waiting in your seat for, okay? So get ready, everybody. I'm going to bring up Ed so he can give his thoughts and also his action plan and bombshell announcement for the rest of us. All right? Thank you.